The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome to Your Money Your Call. I'm Kim Slater from Kimber Capital, and joining me on the panel tonight is David Buckland from the Montgomery Fund and Ben Clark from TMS Capital. So if you do have a question about stocks or shares, our phone lines are open on 1300 30 34 35, or if you prefer you can email us at yourmoney@skynews.com.au. Gentlemen, we had confidence, consumer confidence slamming into reverse today, which to my way of thinking just shows that the government's budgetary promises can't fool all Australians all of the time. And so it's interesting to see that this fall in sentiment shows that people are still paying down debt and hanging on to spare cash despite the lower interest rates. So in the short term, a crisis of confidence in the economy has to have an impact on the market. My thoughts are that in the short term we're probably in for a bit more market pain, but the real question is, does an election result in September represent, the holy grail for the market and a year-end market rally? So we're in the doldrums at the moment. Is confidence going to climb out in the second half of the year? And will we see that result in the market perhaps moving to 5,500? Dave, your thoughts first.
Well, let's go back a step, Kim. I think the last 10, 11 months, the market has done superbly well despite the economic environment not being overly optimistic. What we're seeing on Montgomery now is a bit of contagion where the resource service companies have absolutely crashed in the last 3 months. On average, they're down about 50 percentage points, despite the fact that the market's up about 10% calendar year to date. And what I'm quite worried about is that there's some contagion and Australia develops a one-speed economy, which is the eastern seaboard slow economy, rather than this two-speed economy. And I think, given the valuations on a number of stocks, I'd be definitely starting to sort of think about taking some money off the table. And I think this election coming up on September 14, can only be positive, because there's no doubt there's a lot of uncertainty around. And as Hawke used to say, if you can't manage your own party, how can you manage the country?
Well, that's very true. But I mean, the interesting thing about when you touched on the resource market, and we'll come back to that in a moment, was the Bureau of Resource and Energy Economics putting a report out today talking about the level of capex that's going on in the market. But as I say, we'll come back to that. Ben, your thoughts first of all on what's happening in the market and what are we likely to see?
Yeah, look, I tend to agree with both of you that the market is pretty pricey at the moment, and I still think that this pullback's going to continue. But what I would say is that within the market, there's these huge discrepancies in performances in different sectors. So I think you can still generate pretty good returns if you're sort of selective as to, where you are, what type of companies you're in. I think a pullback into the reporting season has been a very lively confession session to date. But I do see the potential, to recalibrate portfolios, see how companies are tracking in earnings season. I think that'll be a time when you've really got to start to pick up activity, and hopefully that will set us up for a bit of a run into the end of the year.
Yeah, well, coming back to those figures that the BREE was talking about today, now they're sort of saying that CapEx is a likely scenario in the next 5 years. Committed CapEx in the mining sector is something like 256 billion in 2013, and they see that declining to about 70 billion by 2017. And the interesting thing is we've seen the immediate impact of that in the mining services companies, where, as you said, everything's down 50%. But the interesting thing about the mining companies themselves, as CapEx declines, cash flow goes up. So theoretically, if commodity prices remain relatively stable, we're going to see these bigger dividend or these bigger cash balances with the resources companies, and hopefully better dividend payout. So there is, I can actually see some value emerging in this resources market. And we saw actually today some evidence of that, where the banks were being sold and the resource stocks like BHP were being bought. What are your thoughts? Is that a valid investment thesis to follow?
It depends what your assumptions on the resource prices they'll be selling the products for in the next few years will be, and I think there's a lot of uncertainty. I mean, everyone was very bullish on gold I thought gold would do a lot better than it has done just a few months ago, and we've seen what's occurred there. So, look, I think you've got to be pretty selective within the resource sector in terms of what you go into. I mean, we still own BHP, but not a lot outside of that. In terms of mining services, I just think contracts are being cancelled. Like, look at the CEO of Transfield's comments, which was, we didn't even realise how bad this was getting 3 weeks ago. And he's running a business that's exposed to that. I think a lot of these surveys just aren't picking up on how quickly this slowdown is occurring.
All right, well, let's go to our first caller, who's Doug from Young, because he's got a question on Fleetwood, which came in and reported this week. Doug, welcome to the program.
Yes, thanks, Kim, and g'day, boys. Really enjoy Wednesday nights, especially. Yeah, Fleetwood, I had a look at it after the profit downgrade, and a couple of things really concern me about it, and I'd sort of appreciate the comments. First of all, it looks like it's only going to earn about 16 cents a share for the year and puts it on a ridiculously high PE. And the second thing I noticed in the last half year was that they paid out 20 million in dividends and also borrowed 20 million. So is there much prudent financial management going on at Fleetwood at the moment?
Ben, this is a good one for you because we've talked about this numerous times on the program, and it was and it did run up to about $9.50, $10 a share, and everyone was in love with the stock because it had a high dividend payout ratio and it couldn't put a foot wrong. With this profit downgrade, it was interesting to also note that Fleetwood did say that earnings would be down, but there would be a corresponding but not necessarily offsetting pickup in profits in the caravan side of things. So the actual commentary from the result didn't seem to be that bad, but the market just absolutely hated it. Now, has this stock actually gone into an oversold position?
Look, I personally, I looked at the numbers and I thought it probably had. I mean, the thing with Fleetwood is it does have a very strong balance sheet. Only about 2/3 of its earnings are exposed to mining sector, and that is in the accommodation solutions it provides. It's also getting into building in WA, but I think the issue that analysts are facing is the downgrade for the current year did not look too severe to me. But I think the uncertainty is what does 13, 14, 14, 15 and 15, 16 hold. And that's where when you look to the analyst reaction to it, there was minor downgrades this year, massive downgrades going out. And that reflects sort of the uncertainty in this sector. How prolonged is this slowdown going to be and how severe is it going to be?
Well, with your funds, Dave, you obviously use valuation models to determine what's cheap and what's dear, but I mean, some of these stocks must actually be sort of starting to crazily veer towards that, looking like halfway reasonable buys with the falls that they've had versus the valuation versus where their balance sheets and their profitability sit.
Yes, but what we also need to do is we need to have a rising intrinsic value, and none of these stocks have rising intrinsic values. All their intrinsic values are falling, so we don't own any of them, fortunately. The problem, Kim, and I think Ben touched on it very well, was we've had a sort of come to Jesus type moment with some downgrades in the last bunch of weeks, but that's for fiscal 13. We haven't seen anything for 14 or 15 yet. And as you say, the CapEx spend, if it crashes to the degree we think it will, then what's going to happen is we're going to look back in a bunch of months' time and say, is the resource service super cycle, is it over? Again,
that's the point, is that everyone being too bearish on that CapEx crash, because that's what the BREE was saying today. It's not actually a crash, it's more of it's a decline over a number of years out to 2017. So it's not like the tap is being turned off next week or next month.
But if you've been making supernormal profits and suddenly BHP cut their CapEx and exploration budget by $7 billion a year over a 2 or 3 year period, and Rio cuts their cost base by $5 billion, and things like Browse are just cancelled, and other significant LNG projects are either cancelled or waylaid, and all these companies have set themselves up for enormous amounts of work that's just no longer there, then suddenly as contractors they have to push off their staff, fire their staff dramatically, pessimism prevails, and suddenly there's houses on the market throughout Perth because of really, people think it's never going to end.
Yeah, okay. All right, well I think we might, because I want to come back to this topic because there's the issue of what's going to happen with the mining services, if there's going to be consolidation or what. But it's time for a quick break. Before that, though, it's time to start the stock watch. David, what are you watching? And your time starts right now.
At Montgomery, I'm watching IMF. This is a funder of class actions. It's currently got a book of about $1.5 billion. It's got 26 cases, and the bulk of those cases are worth well over $50 million each. We value the stock, which is currently about $1.90. We valued it at about $2.50. It's got a very strong balance sheet, and we think some very successful class actions are imminent. So we think it's got 20% upside. IMF is the ASX code.